Welcome to the deep dive. Today we're cutting through some of the noise. We want to focus on something practical.
Yeah, spotting potential buys, after a stock gets hit hard.
Exactly. We've looked at technical analysis concepts, searching for those reliable early signs that things might be turning around.
Signals of a potential reversal or recovery.
Right. And the mission for you listening is pretty straightforward. Get a solid handle on these key technical buy setups.
So you can maybe recognize those turning points, feel a bit less overwhelmed when the market gets volatile.
It's really about finding clues in how the market reacts to those sharp drops, isn't it?
It is. We're looking past just the price chart itself. Things like, trading volume, the strength of price moves, seeing if buyers are actually starting to step back in.
Okay, let's dig into some specific patterns then. First up, reversal candlesticks, especially when they show up at key support levels.
Right. Think patterns like the bullish engulfing. You see a small down candle, then a bigger up candle that just swallows it.
Or the hammer. Small body, long lower wick.
Exactly. Or the morning star, that's a sequence. Bearish candle, then a tiny indecisive one, followed by a strong bullish candle.
And the key is where these appear.
Absolutely. You want to see them forming at significant support. Could be a 200-day moving average, maybe a 50% Fibonacci level, or just a historical price low.
And why is that location so important?
Well, think about it. These patterns popping up right there suggest buyers are actively defending that level, overcoming the sellers right where you'd expect some demand.
Like that hammer's long tail shows sellers tried, but buyers pushed back hard.
Precisely. Buyers stepped in and closed it much higher.
Okay, and what gives these patterns even more credibility?
Volume. Definitely volume. If you see one of these bullish patterns form and it happens on noticeably higher volume than usual right at that support.
That suggests stronger conviction.
Exactly. It's not just a few people nibbling. It hints that, more significant money might be moving in, defending that price.
Makes sense. Okay, what about situations where it feels like a stock has just sold off way too much, too fast? Like it's overdone.
Yeah, that's where momentum indicators are really useful, like the RSI, the relative strength index.
Below 30 usually means oversold, right?
Generally, yes. And what's even more interesting is if the RSI starts ticking up while the price is maybe still making slightly lower lows.
Bullish divergence.
That's it. It suggests the downward momentum is fading. Same idea with the stochastic oscillator below 20, and then the percent K line crossing up over the percent D line suggests selling exhaustion.
But crucially, these aren't just buy now signals on their own.
No, definitely not. You get the highest probability setups when these oversold readings line up with other things we're talking about.
Like hitting that support level or seeing one of those candlestick patterns we just mentioned.
Exactly. Think of them as confirming evidence. They support the idea that the selling pressure might be drying up.
Gotcha. Let's circle back to volume. What if you see a massive spike in volume after a big price fall, but the price itself sort of stops dropping?
That can be a really powerful signal. High volume means lots of shares changing hands. If the price stabilizes around, then maybe forms a tight range or some doji candles, small bodies.
It suggests buyers are absorbing the selling.
It can, yeah. It could mean strong buying is meeting the sell orders. Or maybe it's seller capitulation. Everyone who wanted to sell has finally sold.
And then what?
Then you watch for a break. If the price pushes above a recent high, maybe the top of that little range, especially on continued strong volume, that's often a sign the tide might be turning.
Okay, moving averages. People talk about the 50-day and 200-day all the time. How do they fit in after a drop?
Well, they represent average prices, so institutions and traders watch them closely. They often act as dynamic support or resistance.
So a bounce off one is key.
Yes. If the price falls sharply, touches or just dips below a key MA like the 50 or 200 day and then reverses back up, especially with a solid bullish candle and maybe increased volume.
It suggests buyers see value there relative to the recent trend.
That's the logic. It's a widely watched level holding firm.
We touched on bullish divergence with RSI. Can we see that elsewhere?
Oh, yeah. You can spot bullish divergence on MACD, its histogram especially, or other momentum tools. The core idea is the same. Price makes a new low, but the indicator makes a higher low.
Signaling that the selling pressure is weakening internally.
Right. And again, look for confirmation. Does it happen near support? Do you get a reversal candle, a volume spike, a break above a new term resistance like the 20-day MA? That all strengthens the case.
What about if a stock just goes sideways for a while after falling? That consolidation.
That basing period can be important. It shows the downtrend has paused, sellers aren't pushing it lower, Buyers are maybe starting to build positions.
So the signal is the breakout from that base.
Exactly. If the price then breaks decisively above the top of that consolidation range, especially on good volume, say 1.5 times the average,
Hmm.
that suggests buyers have taken control and are ready to push higher.
Okay, one more. Fibonacci retracements. Briefly, what are they and how do they help?
Their percentage levels, 38.2%, 50%, 61.8% are common drawn between a major low and high. After a sharp move down, traders watch these levels as potential spots where the price might find support and bounce.
So if a price falls to, say, the 50% fib level and you see other signals there.
Like a bullish candle, or oversold RSI turning up, or a volume increase, it adds weight.
Mm.
It suggests buyers are stepping in at a mathematically derived level that many market participants are watching.
So bringing it all together, what are the crucial things to remember for finding high probability signals?
Number one is confluence. The best signals happen when multiple indicators line up. A hammer candle at the 200-day MA with oversold RSI and rising volume, that's much stronger than any single signal.
Right, multiple reasons.
Yeah. Also, market context. Trying to buy dips is much riskier if the overall market is crashing. These work better in corrections within uptrends or when the general market is stabilizing.
And risk management is essential.
Always. Use stop-loss orders. No signal is perfect. There will be false signals. And generally, these setups tend to be more reliable on daily or weekly charts, filtering out some of the noise from shorter time frames.
Okay, so quick recap. We've covered reversal candlesticks at support, oversold indicators like RSI and stochastics, volume surges as price stabilizes, bounces off key moving averages, bullish divergence, breakouts and consolidation, and Fibonacci retracement levels.
A whole toolkit of potential clues.
All pointing towards potential turning points after a sell-off.
Exactly. They suggest selling pressure might be easing and buyers could be regaining control.
So here's a final thought to leave you with. How might combining these technical signals we've discussed with a solid understanding of a company's fundamentals, its actual business health and prospects, potentially sharpen your edge even further?
Yeah, imagine finding a fundamentally strong company whose stock has been unfairly punished, and then seeing these technical buy signals appear. That could be a really potent combination to explore.